Hey everyone, welcome back to Mind Over Markets, where we explore the stories, emotions, and decisions shaping our financial world. I'm Ethan, and today we're diving into a topic that's both fascinating and a little unsettling: the psychology behind digital money. Why do people rush to buy crypto when prices soar, only to panic and sell when they crash?
Hi, Ethan. Thanks for having me. I love this topic because it's such a perfect intersection between technology and human behavior. People often think cryptocurrency is all about math, code, and blockchain, but in reality, it's more about emotion than numbers.
Right, that's what amazes me too. I mean, Bitcoin was created as a decentralized, logical system, yet the market moves more like an emotional roller coaster than a rational machine.
Exactly. Since Bitcoin appeared in 2009, it's been like a live experiment in mass psychology. You can watch greed, fear, hope, and regret all play out in real time. According to studies from the Bank for International Settlements, over 80% of retail investors lose money, not because the opportunities aren't there, but because of recurring emotional cycles.
80%? That's huge. So what's actually happening in people's minds when crypto prices start climbing?
Let's start with what we call the euphoria phase. When prices rise sharply, confidence transforms into overconfidence. Investors start to believe they can't lose. That's when the "I'll miss out if I don't buy now" mindset, or FOMO, takes over. Rational thinking goes out the window, replaced by crowd behavior.
That reminds me of 2017, when Bitcoin skyrocketed to nearly $20,000 before crashing by over 80%. Everyone I knew was talking about ICOs, and people who had never invested before were suddenly buying coins at the top.
Exactly. And the same pattern repeated in 2021. NFTs, meme coins, institutional inflows, it all created a sense that the rules had changed. Bitcoin hit $64,000, and then Terra Luna collapsed, FTX went bankrupt, and over $2 trillion in market value disappeared. It's fascinating and tragic that despite all the lessons, human psychology still drives these cycles.
You know, the October 2025 crash proved that too. Even with more maturity and regulation in the ecosystem, Bitcoin dropped from 126,000 to 105,000 in hours. That's like watching $19 billion evaporate almost instantly.
And what's interesting is that the trigger wasn't even technological, it was geopolitical. US China trade tensions. The fundamentals didn't collapse, but investor confidence did. It shows how emotion can override logic even in a supposedly decentralized market.
So let's unpack that a bit more. You mentioned euphoria earlier. How does that shift into panic so fast?
Think of it like a pendulum. On one side, you have euphoria. Everyone's convinced they're geniuses. On the other, you have despair. Everyone thinks it's the end. When prices rise, investors seek confirmation, not caution. Social media amplifies the noise. Influencers make wild predictions. Friends post screenshots of profits. And suddenly, buying feels like belonging. But the moment prices start to fall, that same network spreads fear. Panic selling accelerates the crash.
So it's not just numbers, it's collective emotion, like financial herd behavior.
Exactly. It's a psychological mirror, and herd behavior isn't unique to crypto. It's just more visible here because of the volatility. The emotions are raw, unfiltered, and constant. There's a saying in behavioral finance: markets are driven by stories, not spreadsheets.
I love that. Stories, not spreadsheets. So in this story, who are the main characters? We hear about whales, small investors, and influencers, but who actually sets the tone?
It starts with the early adopters, the so-called whales, during the accumulation phase. They buy quietly while the public is skeptical. Then, as prices rise, media attention and influencer hype fuel mass participation. By the distribution phase, Whales are selling to the enthusiastic newcomers. And finally comes despair, when the newcomers panic sell at the bottom, often swearing never to invest again.
That's such a predictable human cycle. Hesitation, excitement, denial, panic, regret. I've seen it in housing markets and even with pandemic stocks.
Exactly. The crypto market just speeds up that emotional loop. What takes years in real estate can happen in months or even weeks in crypto.
Let's talk about the hidden cost of all this. Everyone hears about billionaires losing billions, but what about everyday people?
That's the heartbreaking part. After the FTX collapsed, Sam Bankman-Fried lost around $20 billion. But ordinary investors, teachers, students, small business owners lost life savings. During the 2022 crypto winter, the average small investor lost about $431 from an initial $900 investment. That's nearly half of their capital gone. In places with limited financial education, the losses were even more severe.
And the emotional toll must be huge, not just financial loss, but guilt, shame, and distrust in the system.
Absolutely. People feel betrayed by the market, by influencers, even by themselves. And that emotional baggage can make them either overly cautious or reckless in the next cycle. That's why understanding your emotions is as critical as understanding your portfolio.
So let's pivot to that emotional mastery. How can investors avoid falling into these traps?
First, self-awareness. Recognize that emotions will show up, greed, fear, excitement, but you can choose how to respond. Before investing, define clear rules: when to buy, when to sell, and how much you can afford to lose. The worst decisions come from impulse.
That's so true. People think discipline kills creativity, but in investing, discipline creates freedom.
Exactly. Discipline and diversification are your best defenses. Don't overexpose yourself to altcoins, for example. In every crash, altcoins drop 60 to 80%, while Bitcoin and Ethereum usually recover faster. And avoid leverage unless you truly understand the risk. Mass liquidations in 2025 were catastrophic because so many people borrowed to amplify their positions.
So, if you had to summarize the key lessons from the past few years of crypto chaos, what would they be?
Sure. 1. Avoid excessive leverage. 2. Don't chase hype. Do your own research. 3. Diversify across assets, not just coins. 4. Stay emotionally stable. And 5. Think long term. If your plan is based on data, not dopamine, you'll survive any downturn.
That's gold. And it really highlights something we often forget. Money isn't just about numbers, it's about mindset. The way we feel about money shapes how we use it.
Yes, and crypto amplifies that because it gives an illusion of control. You can trade anytime, anywhere, which feeds impulsive behavior. But true financial freedom isn't about chasing quick wins. It's about awareness and patience.
It's interesting, you mentioned awareness. In the document you shared, there's a powerful line. The greatest losses don't come from market volatility, but from emotional volatility. That hit me hard.
That's my favorite line too. It captures the essence of behavioral finance. You can't control the market, but you can control your reactions. That's what separates investors from gamblers.
I guess that's the paradox of digital money. It's supposed to be rational, decentralized, transparent, yet it reveals how irrational humans can be.
Exactly. It's not just about financial growth, it's psychological growth. Every crash teaches humility, patience, and resilience. The market is basically a mirror. If you look closely, it shows you your own biases and impulses.
I love that perspective. It makes investing sound almost like a spiritual practice.
In a way, it is. The market tests your ego. It rewards discipline and punishes overconfidence. And when you finally detach your self-worth from your portfolio, that's when you truly grow as an investor.
That's such a refreshing take. So Clara, before we wrap up, what's one practical habit our listeners can start using today to stay emotionally grounded in this volatile market?
Keep a trading journal. After every investment decision, good or bad, write down why you made it and how you felt. Over time, you'll see patterns. Maybe you buy after watching a hype video or sell after a panic tweet. Recognizing those emotional triggers can save you thousands.
That's brilliant. It's like journaling for self-awareness, but with a financial twist.
Exactly. Emotional intelligence is the ultimate investment skill. Data and charts matter, but self-control determines survival.
Well, that's a perfect note to end on. Clara, thank you so much for this insightful conversation. I feel like we all learned a little more about markets and ourselves.
Thanks, Ethan. Always a pleasure discussing the human side of finance.
And to our listeners, remember, markets rise and fall.